Welcome to the Deep Dive. Today is Wednesday, January 21st, 2026, and we're looking at the January 22nd edition of the vivimoneyDaily. And frankly, the market feels like it has a split personality right now.
It really does. It's a classic tug of war. Usually, the market picks a lane. Either it's risk on, full steam ahead into tech, or it's risk off, hiding out in gold.
But now we're doing both at the same time. You've got this AI and tech story screaming risk on, and then this huge flight to safety in gold.
That is the perfect sign of a confusing macro environment. And the real story, the one that explains this whiplash you might be feeling, is sort of hidden in the plumbing of the financial system.
The plumbing, okay.
Yeah.
So in the next 5 minutes, our mission is to unpack that. We'll hit the macro risks, this massive crypto liquidation event, and the specific numbers you need to know.
Let's do it.
All right, so let's start with the big picture, the macro. Are we still just talking about interest rates?
Unfortunately, yes. It all starts with the 10-year Treasury yield. It's stubbornly hovering in that 4.15% to 4.30% range.
And that level, 4.30%, is a problem because it just makes everything else look less attractive, right? It's the risk-free rate.
Exactly. It acts like gravity on growth stock valuations. But the yield is just the symptom. The real issue is that plumbing, I mentioned. We have this lingering signal from the end of 2025.
You're talking about the repo markets? The report mentioned some Fed data.
Yes. On December 31st, 2025, the New York Fed's Standing Repo Facility, or SRF usage, hit a record $74.6 billion.
Okay, so the SRS is basically the emergency cash window for banks.
Right, and record usage means they were scrambling for cash. At the same time, the overnight reverse repo had about $106 billion parked.
So there's cash, it's just not moving. The pipes are clogged.
Precisely. It tells us liquidity is much tighter than the stock market seems to realize, which creates a very fragile floor.
And what about the actual economy? The jobs data from December was pretty weak.
Very weak. Only 50,000 jobs added. Unemployment is around 4.4%.
So that's bad news is good news. The Fed can cut rates.
In theory, yes. Inflation is cooling, but there's just so much political and judicial uncertainty that the path forward is, well, it's cloudy.
Which is why capital is fleeing to the one asset that loves uncertainty.
Gold! The fear trade is in full effect.
The numbers are pretty wild. Spot gold touched a high of $4,887.82.
Almost 5,000 an ounce. It's pulled back a bit to around $47.96, but the trend is clear.
And what's driving it?
It's institutional. Central banks, private hedging. Goldman Sachs just raised their end of 2026 forecast for gold to $5,400 an ounce.
Wow, $5,400. That's a bet that this chaos isn't going away.
That's exactly what it is, and we're seeing it confirmed in the VIX, the fear index.
Right, which recently closed around 20.09.
And 20 is that magic line. Above it, investors are actively buying protection, buying insurance for their portfolios, and that insurance is getting expensive.
Okay, so that's the risk-off side. Let's pivot. What about the risk-on gamblers? It's been a rough day in crypto.
A very rough day. We're seeing a massive leverage flush. Bitcoin is trading in the $89,700 to $90,200 range.
But the real story is the liquidations.
That's the headline. Over the last day or two, more than $1 billion in long positions were liquidated.
$1 billion. So that's just forced selling from traders who were over-leveraged.
Correct. It's a cascade. Selling triggers more selling. It's the sound of too much optimism getting wiped out, and fast. The crypto fear and greed index just plummeted from greed down to fear.
And the altcoins got hit even harder, I assume.
Oh, absolutely. ETH is down around 3,100 to 3,300. Solana is volatile around 130 to 140. And BNB is hovering between 880 and 920.
So is money still flowing into the AI trade in traditional tech? Or is that next?
It is, but it's very selective now. Nvidia is holding up, trading around 178 to 186. But the market is only watching one thing: corporate purchasing. Are the big guys still buying chips?
And those pre-stocks, like trying to buy private shares of OpenAI.
That's just high-risk, low-liquidity speculation. In this environment, you do not want your money locked up in something you can't sell.
Okay, let's bring it all together. What's the one-sentence takeaway here?
Inflation is weak, which is good, but liquidity issues and geopolitical risks are causing extreme volatility.
So what's the actionable strategy? What do you do with your portfolio today?
The report lays out 4 things. 1, defense first. Your core should be in broad ETFs like VOO or QQQM, things you can sell.
Keep the core boring. Got it. 2.
Maintain your gold exposure. With that Goldman forecast, it's your primary hedge against the chaos.
Okay. And for tech and AI?
Buy the dips on leaders like NVIDIA, but use options for protection. Don't just buy the stock outright. Define your risk.
And finally, crypto. Is this the time to buy the blood in the streets?
Extreme caution. Small positions only. You need to wait for this leverage flush to finish. Don't try to be a hero and catch a falling knife.
That sounds like solid advice. One last number to watch.
Keep an eye on the dollar index, the DXY. It's around 98.7. If that thing spikes, it's a wrecking ball for risk assets.
So stay defensive, watch the plumbing, and be careful with leverage.
That's the snapshot for today.
This has been incredibly insightful. Thanks for breaking it all down for us. And to our listeners, good luck out there. We'll catch you on the next deep dive.